I don't think gold prices are going to correct to the level where it is possible for the retail investors to start buying gold jewelry or gold TT bars in the way it has been done so far. Things have changed like a one-way door. Gold has entered a phase where it is impossible for it to come back. And there are reasons for it, is what I see. I buy physical gold, sell physical gold, I do options trading in gold, and hence I have some background on how the gold responds to certain situations. Do you know that gold has actually corrected very significantly in the past? In the 1970s, when gold broke away from the Bretton Woods Agreement, initially gold behaved like an inflation hedge. That is because fractional reserve banking had then started kicking in. But as the days progressed, gold no longer confined itself to be only an inflation hedge. Gold represented going long on fear and skepticism. And hence, in the day and time today, you will notice that there are several commodities, even stocks, which respond well to become an inflation hedge. But nothing will match the ability of gold to absorb in fear and systemic uncertainty. Let us go through a brief history of what are all the occasions where gold has corrected itself significantly and why this time gold correction is impossible and it is totally different from the past. Stay tuned. Here is a consolidated data. Looking at this data and analyzing will give us a lot of clarity. You notice that gold isn't just a metal, it's a scoreboard for trust. The reason for this trust has been historical and has been there for generations. And hence it is impossible to dislodge human behavior, and hence there is a lot of trust ingrained into this very commodity called gold. This table shows when trust broke, why investors rushed to gold, and what happened thereafter. Each row is a crisis. The columns show the event trigger, gold's role or hedge type, the start price in USD per gram, the peak during fear, and how far it corrected once confidence got returned. Let us consolidate the sovereign trust hedge. Dot-com bust, accounting scandals in the period 2000 to 2002. The markets lost faith in corporate earnings, quality and equity valuations. Gold acted as a sovereign trust hedge, a place outside the stock market accounting. The price rose from 1999 and from the lows towards the early 2000 peaks, then cooled as policy credibility improved. Similarly, the 9/11, the Iraq war spillover between 2001 and 2003, it was not just fear, it was uncertainty about policy, growth, and deficits. Again, gold served as a sovereign hedge and less about inflation, more about balance sheet credibility of the system. Next, you had the GFC, the global financial crisis between 2007 and 2009. Banks themselves were in question. When the system is in risk, gold steps in. You see a strong leg up into 2009. And once public trust in financial plumbing evaporates, this is what happens. The Eurozone debt crisis and US downgrade of 2010 to 2011. This is the cleanest sovereign trust moment. Government's ability to honor debts was in play. Gold ripped to a major peak. Once central banks stopped the system and credibility was rebuilt, gold corrected meaningfully over the next few years. So to summarize, the sovereign trust hedge, what triggers it? Doubt in the financial system, balance sheet, banks, sovereigns, or the rules of the game. How gold behaves? Sharp upside during stress, meaningful give back once credibility returns and real yields rise. What is our investor lesson? Gold works like insurance against institutional failure. You expect outperformance during the crisis and mean reversal once policy succeeds. Let's look at the fiat distrust, inflation hedge, and monetary hedge together. The fiat distrust or the regime shift happened, think between 1971 and the early 1980s. This was the time where Bretton Woods ended, the oil shocks hit, inflation ran haywire. That's a fiat regime break. Gold went parabolic because money rules changed. The inflation hedge or the geo triggered spikes when price levels surge from supply shocks or loose policy. Gold protects the purchasing power. It rises fast, But if policymakers crush inflation and restore credibility, the long grinding corrections can follow. As a monetary hedge during funding deflation shocks like the early COVID liquidity panics, gold can dip first as investors raise cash, then rally as policy response debases real yields. Then, once growth normalizes and real yields recover, gold cools off. So, what is the executive summary for monetary, fiat, or inflation crisis? If there is a fiat distrust, the biggest, longest cycles can take decades to unwind. If there is an inflation hedge, powerful during the spike fades as policy credibility returns. The monetary hedge or COVID-like situation, there's a quick spike and quicker fade off once the funding stress eases. Next, let's look at the geopolitical hedge. Wars and standoff raise uncertainty about trade, energy, and fiscal path. Gold climbs as geopolitical hedge. If tensions erase, corrections tend to be shallower than the big sovereign trust unwind, but still it is noticeable. What we can summarize about this geopolitical hedge is the driver is conflict tension, and then this clouds the growth and policy. What is the pattern? There is a steady rise, moderate corrections if tensions de-escalate, persistent premium if they do. Now let us look at something totally different, called as the sanction hedge that gold had been exposed to in 2022 until now. This is a new chapter for gold. The reserves of a G20 nation were frozen, Russia. That crossed a line for central banks of many countries like India, China, Turkey, and many alike. This wasn't about CPI, it was about reserve safety. If a country's foreign exchange reserves can be blocked, you diversify into an asset that has no counterparty risk, which is gold. What is meant by counterparty risk? No counterparty risk means that the value of the asset doesn't depend on anyone else's promise or solvency. In gold's case, if you own the asset outright, unlike a bond or a currency, there is no issuer who can default, freeze it, or devalue it. For instance, if you buy a corporate bond and then you claim the bond's value, what if the corporate goes bust? There we have a counterparty risk. But for gold, you don't have counterparty risk. If you own gold, nobody can devalue it. And hence, that is the risk that these central banks wanted to de-risk themselves from the G20 based situation that Russia went through. This has resulted in all the central banks wanting as much gold, physical gold as possible. So the driver is a reserve weaponization risk. Sovereigns want outside money. What is the pattern? This is strong. There's a stickier demand from central banks. Corrections are very much unlikely. And even if it does happen, it is shallower and shorter because once such a D20 based move has taken place, it is like a broken mirror. The chances for the mirror to look seamless is more or less zero. The bottom line is the probability of gold for fully going back to pre-2022 norms is low. Of course, all things being equal, unless there is an extraordinary renewed confidence in cross-border reserve safety, this is highly unlikely.
Hence, the way in which, as a retail investor, we used to buy gold is now slowly changing. Just like we had what is called as stock splits. You remember Amazon stocks, I think they started splitting into 1:10 ratio. Similarly, Nifty Bs in India, they split because then only we will have retail participation. So similarly, there is a possibility that the $10 bar that we have today, by the way, a $10 bar is like 116.52 grams of 24 karat gold. Those are now out of reach of any common retail investor. What might happen is the 24 karat instead of a $10 bar might come to that of a $4 bar instead of $10 bar. That kind of a split is possible. And similarly in the jewelry business, we might have a lesser grade gold that is going to be used and that might be widely acceptable. So we might have like say 6 karat gold ornaments and that might slowly become the norm. So the way going forward can be for the retail investor a shift from where it is today. In the next segment, there is another reason why gold prices are going up, and this has got nothing to do with the fundamentals that we just discussed. This has got something to do with the way in which US can possibly try and adjust its debt of close to around $37 trillion. We will discuss the way US might deal with the growing gold price, because things might actually be in its favor. Okay, stay tuned.